Dell stock, ticker symbol DELL, reported earnings after the close on Thursday, and then on Friday the stock was down about 2%. So the market obviously feeling a certain way, not really liking the earnings in spite of everything. And we're going to talk about that. We're going to talk about why exactly did the stock fall, and is Dell a buy right now, especially with its exposure to the AI trade. But before we dive in, if you guys could please go ahead, like and subscribe. It really helps me out. Let's dive in. Now, for those of you that don't know, Dell is an equipment manufacturer, specifically in the technology space. They make computers. They mostly just assemble computers with the parts, but they put their branding on it. They mostly just make these racks out here for computers in aggregate. They also make monitors, keyboards, mice, everything you need for your workstation, for your desktop, for an office environment. That's their customer solution segment. They also have their infrastructure segment, where they actually go ahead and make server racks for data centers, cloud computing environments. They have a whole range of servers right here. And on top of that, they also have storage solutions for those server racks. And on top of that, they also do storage solutions for your data center and for these servers as well. And Dell believe they are the number one across all of these segments when it comes to x86 servers. They believe they're the number one in North America for commercial PC, for desktop, for mainstream servers, PC monitors, high-end PC gaming, and PC workstations. They also believe that they are number one here for external RAID enterprise storage, high-end RAID storage, mid-range storage, AI-centric storage, converged systems, hyper-converged systems, purpose-built backup appliances, and all-flash array RAID. So if you are buying Dell, you're looking at probably buying the leader, in the field, in this hardware technology, I guess you could say infrastructure based. Now, looking at the earnings in aggregate, it's easy to see why Dell was down on the day, because they actually missed their EPS expectations. The street was looking for $1.69. Dell reported $1.55, which is still 3.8% year-over-year growth. And then revenue actually did beat expectations ever so slightly, and they grew revenue 5.1% year-over-year. Now, the business did have some operating deleveraging going on. We did see gross margins take a bit of a hit. This was largely due to the impact from what Dell says, tariffs. I don't know if that's completely believable. That's exactly what they said, specifically in the customer solution segment. Net income margins actually fell as well. However, free cash flow margins did tick up in a very significant way quarter over quarter. And despite net income margins compressing, we did actually see the nominal dollar figure increase from 960 to 965 million. And then free cash flow went from about 447 million to 2.2 billion. So very interesting to see the dynamics here. So, gross margins, net margins, not that great, but free cash flow margins more than made up for it. Looking at the company's balance sheet, they do have a lot of debt, relatively speaking. I mean, when you look at the fact that net income is $1 billion, free cash flow is 2.2 billion for the quarter, they are very levered, relatively speaking. And they do have 7.7 billion worth of cash to offset that. Looking at their earnings in a more granular fashion, so we know revenue grew 5.1%, cost of revenue actually grew 6.2%, SG&A actually decreased 3%, and you can see here that net income actually decreased negative 3.1%. So how did Dell actually increase their earnings per share by 3%? It has to do with stock buybacks. They do buy back a lot of stock, and that has to do with the valuation, and we'll talk about it. Now, like I mentioned before, Dell reports its earnings in two distinct segments. They got the ISG, their infrastructure solutions, and their CSG, their client solutions. So infrastructure is more the servers and networking part of the business, and then the client solutions group is anything that has to do with the consumer or the commercial space, desktop PCs, etc. So infrastructure ISG grew 12%. This is really what's growing the business, and in fact, the server and networking segment grew 16% in aggregate. Storage didn't grow quite as quickly, and then client solutions grew 5%. And like you would expect, the infrastructure solutions is also the higher margin business, because operating income actually increased 36%. So there's, that cost of revenue was significantly lower as a percentage of revenue compared to client solutions, which actually saw operating income fall 16%. So, if you are buying Dell, you're really hoping that this infrastructure solutions segment really turns into the bigger business, especially on a revenue segment, just to offset some of the losses we are seeing with the CSG segment. And it does look like that can be the case, because the CEO Jeff Clark came out, or the CFO, I believe, came out and said that they are experiencing unprecedented demand for AI optimized servers. And I do believe, looking for the past quarter, they said they have a $12 billion backlog in servers. So this infrastructure solutions segment, that is the higher margin segment, could actually be a higher percentage of revenue than the client solutions group. You could see here that in 2025, a total revenue for ISG was $10 billion. Here for CSG, it was $12 billion. So this could actually be, the biggest segment by the end of the year. And that would be tangible to having the market ascribe a higher multiple to the business of Dell as a whole. Now, their guidance was actually very frothy, adding on to what the CEO said. Now, this is very, very interesting. If you actually look at their second quarter guidance right here, Dell guided for $28.5 to $29.5 billion. They're looking for 16% year-over-year growth, right? The analyst expectation was expecting $25.1 billion at the midpoint. That is why it was very weird to see the price action we saw in the stock with Dell. Maybe the street doesn't believe that they're going to hit this number, but based on the backlog they have, I wouldn't be surprised if that's the case. They also did raise their full year guidance. The consensus midpoint expectation was $101 billion. Dell came in and said, we're looking to do 101 at the low end, 105 at the high end, 103 billion at the midpoint. And Dell believed that the AI trade, right, is going to continue to grow. In fact, they see a 33% compounded annual growth rate through 2027. And you could see right here that AI hardware and services represents a $295 billion opportunity. And if Dell has 29% market share, as you can see right here, they are expected to take a lot of this market share. And that could be as much as $100 billion just in their ISG solutions, assuming that these dynamics do play out, which it looks like it is. So with all that intact, where does this leave us with the valuation of Dell? And it actually trades very, very cheaply. I mean, on a forward basis, right? You're looking at a business at 8.5 times EV to EBITDA, a price to earnings of 12, right? And a shareholder yield of 7.43%. Now, this is simply because the business of Dell buys back a ton of shares. They bought back in the trailing 12 months, nearly 2.5% of the total shares outstanding. That is phenomenal. They also pay a pretty robust dividend yield of about 1.9%, as you can see right there. So they are returning a lot of money back to shareholders. And this is where Dell actually makes a lot of sense as a business. So you sort of have these capital return drivers to get money back in the hands of shareholders. The company is growing. The valuation is cheap. And that is why, the projected returns for Dell sit at 15.62%. I mean, if we just look at 5% growth, right, in overall revenue here for Dell from where we are right now to 2029 on a 10% EBITDA margin, if you apply slight multiple expansion to 12 times EV to EBITDA, again, the stock trades at 10 times, you're looking at 148 billion as an enterprise value. And then you got to add the net debt, divide by shares outstanding. Now, I'm assuming shares are decreased by about 2% every single year. You get a stock price at the end of 2029 of $216. The current stock price is $113 with the 1.85% dividend yield. You get a 15.62% compounded annual growth rate on what is a very draconian valuation and a discounted fair value of about $122. So the stock is, just under its current fair value. So look, Dell looking very, very attractive. And is it a buy right now? I would say yes. In fact, I'm probably going to sell some puts on this name and see if I can get a position. I think Dell can possibly trade all-time highs, which would be very close to that 180 range by the end of the year, assuming that guidance that management gave, pans out. But looking at the technical charts here, Dell's officially above the 200-day moving average, as you can see. After the earnings, it did pull back. If it consolidates right here, I would say this is the place to get in, looking for tangible upside into the rest of the year for Dell. Very, very good earnings. I like the business. I like the valuation. I think I might buy some Dell stock. You're getting one of the best businesses in the world that has, an AI component. And if the AI trade goes on for the next 3, 4, 5 years, right, 10 years, Dell is going to be at the forefront of the server making business. So I wouldn't be surprised to see all-time highs. And you're looking at, 40%, 50% upside from where we are currently. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.